What does Benjamin Graham, Warren Buffett, Charlie Munger, and Peter Lynch all have in common? Firstly, they're all legendary investors, generating vast fortunes with brilliant investments year after year. Despite what many might think, even these four have made many mistakes. All investors, ranging from the worst to the best, will make mistakes along the way. We've compiled the top 10 mistakes most investors make, and in this video we'll share what they are and how you can avoid them. We'll start with the most obvious ones and finish with a few surprises, so stick around to the end. This is investing in a nutshell. Mistake number 1, not diversifying your portfolio. Diversification is key to reducing risk in your investments. In order to reduce risk, you can spread your investments across different asset classes, such as stocks, bonds, and real estate, as well as different sectors and industries. This will help to ensure that your portfolio is not overly reliant on any one type of asset or sector, which can be risky if it experiences a downturn. To avoid this mistake, make sure to diversify your portfolio by including a mix of different assets and sectors. A simple way to do this is to use ETFs that offers diversifications in index funds. Mistake number 2, not having a clear investment strategy. It's important to have a plan in place before you start investing. This includes setting specific goals, understanding your risk tolerance, and determining your investment time horizon. Without a clear strategy, you may end up making impulsive decisions that could potentially harm your portfolio. To avoid this mistake, take the time to think about what you want to achieve with your investments and how much risk you are comfortable taking on. Then develop a plan that aligns with these goals and risk tolerance. This may include setting up automatic investments to ensure that you are consistently saving and investing, and reviewing your investments regularly to ensure that they are still aligned with your goals. Mistake number 3, not staying informed about the companies you invest in. If you want to invest in companies instead of index funds, you need to do your research and stay up to date on the performance and future prospects of the companies you invest in. This will help you make informed decisions about when to buy or sell. To avoid this mistake, make sure to regularly review the financial performance and news of the companies you are invested in, and be prepared to make changes to your portfolio if needed. This may involve following industry news and analysis, reading company earnings reports, and staying informed about the management and leadership of the companies you invest in. Mistake number 4, not having an emergency fund. It's important to have a reserve of cash on hand to cover unexpected expenses, or to have something to fall back on in case of a financial emergency. To avoid this mistake, make sure to set aside some of your savings in a liquid, easily accessible account that you can use in case of an emergency. Aim to save enough to cover at least 3 to 6 months worth of living expenses. This may involve setting up a separate savings account specifically for emergency funds, or choosing a high-yield savings account that offers a good interest rate. An emergency sale of stocks, for instance, during a recession can be very bad for your long-term profits. Mistake number 5, not considering taxes when investing. Make sure to understand the tax implications of your investments, as they can have a significant impact on your returns. To avoid this mistake, consider the tax efficiency of different investment options, such as whether they generate a lot of taxable income or capital gains. If you have a long time horizon and you still believe in the prospects of the company or index you've invested in, you should avoid selling if you have to pay taxes on capital gains. You may also want to consider the tax implications of different types of accounts, such as whether an investment held in a tax-deferred account like an IRA or 401k will be taxed at a different rate than one held in a taxable account. Mistake number 6, trying to time the market. One of the most common mistakes investors make is trying to time the market, or trying to predict when to buy or sell based on short-term market movements. This can be a dangerous game, as no one can consistently predict what the market will do in the short term. Instead, it's important to have a long-term perspective and to focus on building a well-diversified portfolio that's aligned with your investment goals and risk tolerance. Mistake number 7, not considering the fees associated with your investments. It's important to understand the fees associated with your investments, as they can eat into your returns. Look for low-cost options such as index funds, and make sure to weigh the cost of any investment against its potential returns. To avoid this mistake, take the time to research the fees associated with different investment options, and choose those that offer a good balance of cost and potential returns. This may involve comparing the expense ratios of different mutual funds or ETFs, or considering the commissions charged by different brokerage firms. Heavy trading will also increase your fees, as there is a fee associated with each transaction for ETFs and stocks. Mistake number 8, not seeking advice. It's important to have a solid understanding of investing principles and to do your own research, but it can also be helpful to seek the guidance of other investors. To avoid this mistake, always seek new information on YouTube or other platforms, and maybe even consider working with a financial advisor who can provide unbiased advice and help you develop a solid investment strategy that aligns with your goals. Mistake number 9, letting emotions drive your investment decisions. It's natural to feel fear or greed when it comes to investing, but it's important to try to stay level-headed and avoid letting your emotions guide your decisions. To avoid this mistake, try to take a long-term perspective and resist the temptation to make impulsive decisions based on short-term market fluctuations. It can be tempting to sell off investments when the market is down, for example, but this is often the worst decision if you have a long-term investment horizon. Similarly, it's important to avoid getting caught up in hype or buying into the latest hot stock without thoroughly researching the company and its prospects. Mistake number 10, not regularly reviewing and rebalancing your portfolio. Markets change, and your portfolio should reflect these changes. Make sure to regularly review your portfolio and make adjustments as needed to ensure it's aligned with your investment goals. This includes rebalancing your portfolio to maintain your desired asset allocation. If you don't regularly review and rebalance your portfolio, you may find that it becomes out of balance, which can increase your risk. To avoid this mistake, set aside time on a regular basis to review and adjust your portfolio as needed. This may involve selling off some investments that have grown too large a portion of your portfolio and using the proceeds to buy more of other investments that have become underrepresented, leveraging the cheaper prices for these positions. In conclusion, by avoiding these common investment mistakes, you can become a more successful investor. Remember to diversify your portfolio, have a clear investment strategy, stay informed about the companies you invest in, have an emergency fund, consider taxes, take a long-term approach, consider the fees associated with your investments, seek advice if needed, avoid letting emotions drive your decisions, and regularly review and rebalance your portfolio. Remember to always do your own research before you do any investments. We've described what we believe to be the top 10 mistakes investors make, but this is not financial advice. Seek professional advice if you need to. We hope you've enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. If you like this video, we would appreciate a thumbs up, and you should consider subscribing to the channel so you don't miss any new content. Have a great day and good luck on your own investment journey.